Okay, welcome everybody to episode 97 of the Volatility Barometer podcast. So I can see that there's some people here. Just as I clicked go live, it said it had to reduce the stream size because it's got some bandwidth issues. So I don't know. I'm streaming right now, I believe, to Twitter, LinkedIn, couple on YouTube, to both of the channels. I think it was just a little bit too much to handle. So hopefully when it's selected to de-size it, that at least one of them went to the main YouTube channel. Fortunately, I will not know until I'm finished up today and I can actually watch it on the rebroadcast. But we will just continue as if it's going. So thank you everybody for coming. It's been quite a while. It's been a couple of months since I've done this. So today's going to be pretty casual. I'm just going to do one very quick segment and then we'll just get to the live Q&A. Just hang out, get back into the swing of things. Like I said, it's been a while. I think the last time I live streamed, I think it was just right after Trump won the presidency. And now he has, he is now the official president. So lots happened. It feels like it's been a year in the political landscape, but it's only been maybe 2 months. So just one of those periods in history where a lot is changing right in front of our eyes. So we'll see how this all works out. But thank you, everybody. And I also had a little bit of a milestone. I just want to shout everybody out and thank everybody. We have crossed 30,000 subscribers. So I say we because, of course, none of this would be possible without people watching. So I definitely appreciate every single one of you. And I don't think we'll get 30,000 watching today. But yes, very appreciative of anybody who can stop by, ask a few questions, and of course, subscribe, hit the like button, share it with people. You know the drill. And yeah, let's just get started. And I do want to, like I said, get to the mostly Q&A today, but we'll do one segment. So the rundown, just going to talk about something briefly about the total return portfolio. And then, yeah, you can start asking questions. Unfortunately, I don't know. I'm kind of winging it here. My comment section has not brought up any comments. I can see there's people here watching, but I can't see the comments. So after I do this segment, maybe I will actually have to sort of look at the YouTube channel itself and answer the questions there. But, we'll do the best we can. It's been a couple of months. I'm very rusty, so please forgive me. Okay, so what I wanted to talk about today, let me just get into this presentation. What I want to talk about is just something that's come up recently where, a lot of people they tell me that they do appreciate what I call the tactical rotation through volatility targeting. That's what I call my style of investing. They appreciate my style of investing, but they feel like maybe I'm a little bit too conservative for their liking. And of course, everybody has their own level of risk tolerance, so I'm not here to tell you what yours should or shouldn't be. I know what mine is, and remember VTS, this is basically just me sharing what I personally believe is the best way to invest my own money. And I'm sharing it with everybody. You can, of course, follow along, and there is a method that people can actually get the trade signals and follow what I do exactly. If you feel like my style of investing is perhaps maybe better than what you could do on your own or better than the other financial advisors out there, then of course people can follow. But again, different risk tolerance for different people. So some people have told me, I get emails saying, look, it's great, but I don't like the iron condors. The return is a little bit lower. I didn't like the volatility trend strategy, the UVXY Butterflies that we did. A lot of the things that I've done over the years have been for the purpose of reducing drawdowns of the overall portfolio and giving everybody a more smooth investing experience, because that's my risk tolerance. Now, of course, if you are in, I guess, what you would call the stronger growth stage of your investing journey, maybe you're younger, maybe you have a little bit less money you're working with and you feel like you can go for it a little bit, then it's perfectly understandable, right? So just to give you a little quick example of what I'm talking about here, it is somewhat similar to, of course, buy and hold on the S&P 500. I would never want anybody to do this. This is a terrible idea, of course, but it is somewhat similar to trying to diversify from here. So this as the baseline, the stock market will probably return, 10% over time. That's what it's done historically. I suppose because now we're at all-time highs and, debts are out of control and politics is, up in the air at this point. I would be surprised if it returned 10% over the next 20 years, but certainly in the last 30 years, it has returned 10%, 55% drawdown. But what oftentimes people do is they say, look, I can't sustain a 55% drawdown. And I wouldn't expect anybody actually could. You can't watch your net worth go down that far and just wake up the next day and stay the course. So what people tend to do is they add a bond exposure to their portfolio. And of course, this does reduce the rate of return, couple percent lower, but it significantly reduces the drawdowns to something that people perhaps could sustain long term. Now, remember, you have to back out about 5% of real world inflation, so it's not like anybody should actually be doing this. I'm just illustrating it as an example. But adding that bond portfolio isn't for the purpose of boosting the rate of return. It is for the purpose of reducing the drawdowns. And I do something similar in my own portfolio, where I actually do have a couple of aggressive strategies that have made killer rates of return. Nothing wrong with the strategies. They have done fantastic for, 13 years. But there are drawdowns associated with that, especially, defensive rotation. We're dealing with 2 times the NASDAQ. So even though I've done a great job, maintaining low drawdowns, relatively speaking, whenever you're dealing with the 2 times NASDAQ or short volatility in the tactical volatility strategy, obviously drawdowns are going to be larger. So we've got a couple of strategies that are designed to be more conservative and, in the case of iron condors, overtly negatively correlated to the stock market. That would be similar to somebody doing the bond exposure, right? Of course, what is this going to mean? In a good market, you don't need bonds, right? Just do all the stocks. And in a good market, you don't actually need the volatility trend strategy. You don't need the iron condors. You don't need the strategic tail risk. But on a long-term time horizon, that's when I feel like it's very valuable. For me, personally, I don't like to see large drawdowns. So I suppose maybe it's people just misunderstanding what I'm doing. They're looking at it and saying, well, why is this guy even trading iron condors when he knows that, they've been live in the portfolio for 13 years. I know the rate of return of my iron condor strategy is lower than the tactical volatility. It's lower than defensive rotation. I know that for a fact. So, why is this guy even doing it, right? So the point is to reduce the drawdowns. But this is where it gets to somebody's personal risk tolerance, because as I presented in a recent video that I made, there is a way for somebody who is more aggressive in their investing journey to take the total portfolio solution, which is what I trade personally. Full disclosure, everything you see in the email, that's my real money. I'm not presenting anything outside of what I actually do. So I trade the total portfolio in these allocations. Of course, caveat, I also have substantial allocations to my option strategies. But for VTS specifically, I do the whole thing. But if you have higher risk tolerance, there would be nothing wrong with just ditching the conservative strategies and just going for the 2 that are designed for more aggressive growth. And when you see them side by side, I do have to be a little bit careful when I present this, because most people, most investors, they get a little confused when you start talking about risk-adjusted metrics. They tend to look at the headline numbers. They tend to look at, oh, well, this one's 35, this one's 21. Obviously, I'm going to follow this one. But of course, you look at the drawdowns. This one has a 37. This one has a 25. Average of the 3, since we've been going for so long. I've been doing VTS live with, third-party capital for over 13 years. So I like to look at 3 major drawdowns, 24% versus 16. So obviously, it's been a little while since I've done this, but obviously, when you look at it that way, through the lens of, okay, rate of return, one is clearly higher, but drawdowns, they're also clearly higher, that's when we have to talk about risk-adjusted return. And look, full disclosure, this is a difficult thing to communicate to investors. They will probably look at the rate of return, and they will sort of gloss over the fact that drawdowns are involved, because what people tend to do, they will look at a long-term chart, and I can actually present a long-term chart. I can show you this is the absolute return portfolio. And what people will do, naturally their eyeballs are going to be like, oh, okay, well, you start here, you end here, you made 35% return. Obviously, I'm going to do this. They see this drawdown, it registers maybe a little bit in their brain. They're like, okay, I know he told me that there's going to be a drawdown here, but since you see it on a chart and you know that it recovered fully and then blasted off to all-time highs again, people gloss over that drawdown and they don't really put themselves in the position of somebody who's going to actually feel that. I can tell you for a fact that I had people, because VTS is a public business, I have new subscribers coming in all along this chart. Right. So you can imagine every single month there's new subscribers coming in. And yes, there's new subscribers leaving. Right. That's the nature of the business. People come in. Some of them like it. Some of them think it's not for them. So people are coming in and people are leaving the entire time. So that means if you zoom in to let me not move that. If you zoom in to right here, you have to imagine in that 3-month period, I probably had about 50 or 60 new people join VTS. And they joined and watched their money draw down that far, and they left at the bottom disgruntled and angry. And this is the part that investors have a problem doing, because when it happens to you in real time, obviously you're going to feel it. And you're going to think, oh my God, this guy's a complete fraud. This strategy doesn't work at all. But when you see it on a long-term chart and when you see the results and you see the numbers, people have a difficult time thinking to themselves, okay, I understand the whole thing was good, but what would it have actually felt like to have that drawdown? And I can assure you that the total portfolio solution, having only drawn down an average of 16% versus 24%, it feels more comfortable. It is more likely that you would push through those difficult times. So I'm not trying to say anybody should go in any certain direction. I just want to be very clear that I'm not trying to advertise that one is better than the other. If you actually look at what I call the risk-adjusted metrics. And for me, I invented my own metric score that basically combines the rate of return with the 3 largest drawdowns. You can see the performance score is about the same. One of them is higher, sure, but this is basically about the same. So you're left with 2 portfolios, one of them more correlated to the market, one of them higher return, one of them will definitely have larger drawdowns. The other one, more consistent, but during really good periods in the market, like the last 4 or 5 years, it's going to seem fairly redundant and not overly necessary to be so protective of capital because the market's been doing great. And every time it dips, every time it goes down, you think, okay, here we go, we're going to cycle into safety. And then the market recovers and you end up looking stupid. Yes, during good times in the market, you are not going to need the conservative strategies. But overall, personally, this is where my money is at. But full disclosure, of course, there is now 2 portfolios. And I also just, for full disclosure, if you want to get, nope, that's the YouTube channel. Hold on a second. Told you I'm rusty. It's been a couple of months since I've done this. So on the website, I have actually included the aggressive portfolio as well. You can watch the video. Can read a little bit about it. It's essentially just our 2 strategies. You can watch both individual strategy videos and then you can see the performance down below. And again, when you're looking at it on a chart, it's going to seem like this is your obvious choice, but I would implore you to try to imagine. It's not like the drawdown was bad. Remember, the market itself had a huge drawdown during then as well. 2022 was a nightmare for investors. It was one of those years where both the aggressive assets and the safety assets, they all crashed together. Real estate, utilities, gold, everything was down that year. So it was actually a difficult year. But nonetheless, it's a drawdown, and you have to try to imagine what that would have felt like. So you can see the results here, pretty consistent, pretty great recently, but there is drawdowns involved. So I want to make sure that I'm not, as a person who tries to be as ethical and transparent as possible, I do want to make sure that everybody understands that I can't overtly recommend anything. I can't tell anybody what to do. This is just me investing my capital and sharing it with the world. But please make responsible decisions. Please understand that drawdowns in real time feel a whole lot different than they do when you watch it on a chart and you already know that we're way above all-time highs. We way recovered from that already. So, easy decision now. Not such an easy decision in 2022. So just bear that in mind. So that's it. We call that the absolute return portfolio. Absolutely nothing has changed. This is nothing new. It's not like these are not new strategies. These have been in the portfolio for many, many years. Traded identically, right? Literally identical. So when it comes to the daily email, I should have fired this up before. Apologies. I'm usually a little more smooth with it. If you're new with us today, subscribe and come back, give me another chance when I'm actually a little bit more organized here. But for the daily email, I am going to present it exactly the same way as I always do. I'm not going to draw any additional attention to the fact that you can drop it down to just 2 strategies. So this is our daily email. This was today. This is what it looks like. Top, you can just at a glance, you can see if there's new trades. The only addition that I have made is I've made a little bit of a separation here for total portfolio. As I said, most of you will follow this. I've made it clear that there is a way to get the effectiveness of my strategies, the tactical nature where we're cycling into safety. You can still have that, but still chase your higher return if that's what you're looking for. Below this point, the email is going to be identical. I'm not drawing any additional attention. This is a total portfolio solution with 4 strategies, barometer, and then all the signals for all the strategies are here. Of course, then we've got the daily blog, we've got a clip section, library, everybody, there's full courses in our library for anybody who's new, and then all the volatility metrics for today's readings are here. Everything that you see in blue, these all have individual articles written. You can kind of read about them and see what they're all about, but nothing has changed. So for anybody who's a VTS follower, this will basically come and go. No real news, nothing has changed for you. Your email looks almost exactly the same. And I would imagine you already kind of know what you've been investing in. If you've been with me for a while, you know that I do favor capital preservation, good solid growth. I mean, there's absolutely nothing wrong with a 20% annual return. Lately, it's been lower out of the bull market or out of the bear market. Of course, it's going to be higher. Ebbs and flows, right? It does seem in the last 4 or 5 years, we are on one of those stretches where the stock market sort of makes us feel like it's going to fall off a cliff. And a lot of people are like, when is this thing going to crash? When is it going to, when is Armageddon? And then it's just buy the dip, everybody comes in and everything's fine. So it's just been one of those periods. But I assure you, I actually have a chart to illustrate this too, this recency bias that I think some people suffer from. So this is not updated for the last several months, but pretty close, 2024. This is the 3, NASDAQ, S&P, and the Dow. And what you can see here is marking it from the dot-com bust, basically 2000, you can see that the market took roughly 17 years to recover on an inflation-adjusted basis from that market crash, from both of them, right? A lot of people are looking at this last 4 or 5 years with what we would call recency bias. They're new investors. They weren't investing in 2015. They weren't investing in 2008. They certainly weren't investing in 2002. So a lot of people are under the assumption that this is just how the market functions. Like, of course, the market just goes up. All you have to do is just buy the risky assets and you make all this money. Of course, that's how the markets work, because that's all they've ever seen. But I can assure you the last 5 years is the aberration. That is the outlier. It's not the norm. The norm is the average recession cycle in the United States is 6 to 7 years, and we should expect, especially given how uncertain these times are, would not be surprising at all if there's a major market crash at some point. I'm not going to call it like it's happening this year, but it would not be out of the ordinary at all. So just understand that the decisions that you're making, try to imagine and try to stretch them out for a 30-year period. Don't make decisions today based on what you've seen in the last 4 years. That would be a mistake, in my opinion. So there you go. We've got 2 portfolios. Can follow the one you like. Again, like I said, it's not for me to tell you what you should do, but I can just tell you what I do. And I love iron condors, even though, of course, the rate of return is lower. All we're doing with iron condors is we're selling volatility. We are capitalizing on the volatility risk premium. It's not that big. The volatility risk premium, capitalizing on that, we are non-directional. It's not possible to harvest the volatility risk premium and make 50% a year. It just can't happen. It's not that big. There's a bandwidth of about 10 or 15% there, and then you can maybe stretch that a little bit higher. The iron condor strategy has returned about 16% for the last 13 years, live trading, very little drawdowns. it's kind of the best it's going to do. It's never going to be as good as my 2 times NASDAQ strategy. It's never going to return as much as my short volatility strategy, but it's not supposed to. And bonds are never going to return as much as the stock market. They're not supposed to. That's not the point of it. So what I would tell people to do is, if you don't like the lower diversified strategies that we have, compare them to bonds, gold, utilities, all of the counter trend assets, compare them to those. Don't compare them to crypto, double NASDAQ, short volatility. It's not a fair comparison. And then when you do that, now it becomes actually quite clear. Yes, if you can have a diversifying strategy inside a portfolio that actually still makes a positive return, that is something worth doing. Even though it's not flashy, it does drag down the overall performance. It helps, right? That's why I do it. I'm kind of selling my own portfolio here, but that's why I do it. There's all 4. So yes, make your own decisions. Feel free to email me any questions you have. I can send you more data if you want to hone in on some of those periods. You think, well, maybe help me out with this decision. Here's my situation. I never ask people about their personal situation, but if you want to email me and offer some background of your history and your job and, your situation, I can help guide you a little bit. I will never tell you here's what you are going to do, but I'm here to help. So emails are open, and the emails are unchanged, basically. So there it is. We will go ahead and open it up to questions. You can do a little bit of off topic, as always, if you want. These are my interests, but I would imagine most people have trading related questions. I see Dubai there. People are always asking about that. Super interested. And every year it's going to be even more and more, because the world is going crazy, and places like Dubai, where I live, I'm a resident of Dubai, for anybody who doesn't know, they're just rational, normal, forward-thinking places. So it's not surprising that people are moving there in droves. Yeah, there's going to be some Dubai questions. So yes, hello. Everybody's saying hello. Wife dropping in, saying hi. Definitely appreciate everybody supporting the channel. 30,000. I'm in a really tiny little niche here of niche, whatever, of, volatility trading, and not even options trading. Options trading is probably a little bit larger market. I mean, we're talking about volatility targeting, basically. 30,000 subscribers on YouTube is beyond my expectations. So I really do want to thank everybody for supporting. I know I'm not the most exciting person in the world, but people can manage to sit through a live stream and ask questions. It's great. I'm surprised. I'm always surprised, but thank you very much. All right. Glad to watch. I normally have to catch the replay. Yeah. That's another thing. I've kicked around the idea of actually just pre-recording them and splitting it up into 2 separate live streams. So maybe I can run this by you and see what you think. But because I get roughly, 10% of the overall views of one of my live streams is actually live, and then the other 90% is just people catching the rebroadcast. So if I wanted, I could just pre-record them like everybody else does. Very few podcasts are literally live like I do them, just off the cuff, open. There's no moderators ask me anything, try to embarrass me. It's all open. Nobody does this, but I could branch it off and do pre-prepared, live streams, and then have a secondary live chat only, where we just dive in right away for the questions. So just give me your thoughts in the comments, see what you think. You're not alone. A lot of people watch the rebroadcast. Hello, how are you? I'm not in Dubai anymore, but I will be back, and we will have another meeting soon. I look forward to our next chat. Do you think, what's annoying? I'm going to change this off the screen. You can see all my interviews there, or my interests there. I'm going to take this off so people can see it. And I'm going to put this here. I don't know if you guys can see this happening in live. I hope not. Just so we can all see it a little bit. Do you think Dubai is a better place to raise... Oh, didn't save. Do you think Dubai is a better place to raise kids and a family than, for example, Canada? So, yes, for anybody new, there's not as many people today, but there's enough of you that probably some of you don't know me. So I'm a Canadian. I live in Dubai. I live half the year in Taiwan. My wife's Taiwanese. She's in the next room. I'm in Taiwan right now. It is 1:30 in the morning for me. But I basically, for the last couple of years, I've split my time pretty evenly. I'm an official resident of Dubai, but for the last, 17 years now, I've lived at least half the year in Taiwan, and it's awesome as well. So I do feel like somewhat of I wouldn't say a traitor to my own country, but my appreciation for the Western countries has declined significantly in the last 10 or 15 years. And a lot of people criticize me for that, the fact that I have left my own country. But what I would say to you is, when you actually live in a country that is run well, it is impossible not to look back on our own countries. In my case, Canada. In many people's case, it would be the United States, the United Kingdom, it would be Germany, France. It's very difficult to look at those countries and think back to our upbringing and still think that these are the best places in the world. Unfortunately, they're not. It's been quite a long time since they were. You just see it so clearly when you live in places that just make sense. And I have to use Dubai as the example. I could use Taiwan as the example as well. Let's do that because I always do Dubai. Taiwan has, for all intents and purposes, no crime. Like, just none. It's not even a consideration in this country. I was just talking to my nephew. We just had Chinese New Year. Happy Chinese New Year to everybody. But his name's Ping Yen. Great kid. I was chatting with him, and he was talking about guns and how, he was asking me about the guns in America and, Canada and how unsafe schools are. And I mean, the kid's like, 8 years old or something. And it's just one of those things that, Taiwan, Dubai, of course, as well, zero crime, fantastic education system, healthcare, immediate, taken care of right away, virtually free. In Taiwan, I mean, I had a cancer thing where I had to do all the radiation. I had to do a couple surgeries. It happened in Taiwan. So, I mean, it was pretty scary. I got surgery the day after I was diagnosed. And I'm not joking. The whole thing cost me maybe 2,000 NT dollars, which is 600 US dollars. And I didn't even have healthcare. So this gives you an example of how countries can run if there's actual motivation there to do it correctly. And so, I mean, it's just so palpable when you live there. So this is a whole long way of saying I don't want to be overly critical of my home country because I love Canada. I love Vancouver. I was born in Calgary. I lived there for 20 years. Honestly, one of the most beautiful places in the world. It's a bucket list destination for a lot of people in the world where I was born. My backyard is Banff and Lake Louise and Lake Moraine and all the things you've seen on Instagram, these incredible landscapes. I lived 40 minutes away from that. So blessed, very blessed. But I just got to say, absolutely. Like, raising a family in Dubai, it is such a family-oriented place. Everywhere you look, there's family, there's kids running around. Again, absolutely zero crime. You could let your kids walk home from school. I used to walk home from school when I was a kid. Prince of Wales was maybe, I was a kid, so it felt like 10 miles, but probably, to be honest, it was probably a mile and a half. And I used to, grade 5, grade 6, I used to walk home by myself. You can't do that anymore. Not in our home countries. You just can't. And in Dubai, of course, you could. In Taiwan, you can. Crime is huge. Taxes, huge. Big, big deal for people. This is why many millionaires and rich people are going to those countries, because safety is number one. Kind of reminds me of that movie. I don't know if you've seen it. It was called, was it Out of Time? It was Justin Timberlake. He had that, you have your time stamped inside your basic code, and as long as you have time, you get to live, and then when your time expires on your hand, you basically die. It was a really cool movie. I don't think it was very well executed, but it was an awesome movie. And remember the conversation near the end where the super wealthy guy said, how does it feel now knowing that you're basically living a perfect life outside of a random act of violence? And I feel like there's a lot of truth to that in the actual world we live in, where once you reach a certain level where you've got enough money and you've got your family and you're doing well in life, it's really only a random act of violence or an incredibly stupid financial mistake that could cost your life. Otherwise, you're living great. And so when you're in these countries and you look around, when you're in Dubai and you've got a little bit of assets and you've got your family, and I mean, I'm sure these people feel like this is it. I just get to coast it in and do whatever I want. You're never going to be comfortable doing that in London. You're just not. It doesn't matter how much money you have. You're never going to feel comfortable sending your kids to school in London. Hopefully this is sort of a roundabout way of not trashing my own country, but also saying, yeah, look into it, give it a shot, move somewhere civil and safe and low tax, and just, I dare you to move back to your home country. It just wouldn't happen. So, long rant. The world is changing. The one thing I always remind people is just because you were born somewhere doesn't mean you owe any loyalty to that country. You can move. You can go where you're treated best. All right, everybody has a plan until they get punched in the face. Probably a comment when I was talking about risk management. That's absolutely true. Everybody thinks they've got it all worked out until something unexpected happens. And that is my job as a risk manager, to make sure that when the unexpected happens, I can't predict it either. I don't know what it's going to look like. I don't know what the next market crash is going to look like. I just know it's coming. I know it's going to be bad. And I know I have to prepare now when the markets are at all-time highs. I have to be ready for it. Otherwise, scrambling around for a makeshift plan while it's happening is just not going to be good enough. So this is why I actually still to this day, even though in the last 4 or 5 years, it has not been necessary to be safe. The riskier and dumber that you were, probably the more money you made. But that is not a long-term strategy for success, I promise you. I miss the VXX short trade overlays. I do personally as well, but it was a fairly hated strategy. So I have decided to just go ahead and shove that into the VTS Options Academy that is coming when I finish that course. They will be coming back. I will find a way to make sure I explain in a much better way, because honestly, that one's on me. I just didn't have the time to fully explain. It needs a course. It needs videos, underline. A lot of questions can be answered ahead of time with a good set of 10 or 15 videos. So when I put those together, you'll see it come back. Can we see the month-to-month return? Download from somewhere. Download, no, I don't see the point in that. But if you do go to the website, sure. I mean, you can see it. It's here. And I update every month, so you will be able to see this. I don't think it's overly helpful for anybody to download that. I don't know why it would be necessary, but yes, you can see it right there. All right. Can we see the month? Make sure I don't miss anybody's question. Been following for a while. Videos are really helpful. Thank you. Yes, no problem. Thank you for the support. Oh, another thing too, that's very cool. I can see all YouTube icons. So as far as I know, this is live streaming to the correct place. I sure hope so. I have a quick, that is bothering me how small that is. I have a quick question. Do you buy ETFs like SPY, GLD, and IYR directly as stocks, or do you trade them through long calls and puts? Since I live in the EU, I can't buy US-based ETFs directly due to MiFID. Yeah, your MiFID II regulations are terrible. So unfortunately, I feel your pain. I think that's terrible. If you go to my website, go to the blog section, type in MiFID. I hope it comes up. So this is a really old article, 2018. I should update this, but essentially this is directed at some partial solutions for European investors, just to keep everybody up to speed. If you are in the European Economic Area, they passed these MiFID II regulations where essentially they need something called a KID document. It's a translation into the local language, even though some of the local languages are basically English. They think they're protecting their investors, but what they're really doing is limiting choice. And so a lot of Europeans have either a very difficult time or just flat out restricted from buying US-based ETFs. So one thing that you can do, and in this video, I basically break down all what it is. First of all, the first solution, ETF replacements. I will go through all solutions and then talk about each. The second one is stock replacement through options, which is what you're talking about. And then the third one, which I wouldn't recommend unless you're an advanced trader, is the basically contract for differences market, where you can essentially trade anything you want in a quasi build your own style trade, but you'd have to be pretty advanced. And also it can be expensive. Fees can be a lot higher. There's actually a specific section talking about the cost because there is a lot of hidden fees involved in that. But let's go through it. So it's been 6 years now since the punishing MiFID II regulations came through. So you should be actually able at this point to find plenty of ETF replacements for any of the major ones. And you pointed out, and you're right to do this, we don't trade anything exotic. We don't trade anything low volume. The only ETFs that we trade are major ETFs. You'll probably only have a difficult time with the volatility specific ones, but certainly gold, no problem. Equities, bonds, utilities, no problem. Real estate, no problem. It's just basically the volatility ones. And that's why for this strategy, I actually give stock replacement instructions in every email. So right now, the community is holding the SVXY. It's a inverse short volatility product. You can go on here and you can go through the actual, I have to log in. There's about 15 articles talking about stock replacement, basically teaching you how to simulate an ETF, any ETF, highly liquid ETF with options, puts and calls. And then for the SVXY, we are actually simulating it with long VXX put options because it's actually a very good fit for replacing that ETF. So I do give instructions. I don't give instructions here because, like I said, there's plenty of ETF replacements that you can find, and same with here. Now, you can technically do it, but you need a slightly larger account, but it works fantastic and it's very easy to do with VXX put options. So this strategy specifically, plus the whole course on stock replacement, I believe that's what you're trying to get at there. It's definitely doable. There was a time there for about 6 months to a year where it was pretty frantic, and every day I had 20 or 30 emails talking about this problem. But these days it's like a couple per week. Most people have found solutions and workarounds, and I try to do the best I can. Stock replacement's a very good way to do the volatility specific ETFs. So yeah, that's where I would start. And actually, the last thing, I should just wrap up your question here. The last thing that I would say is what you could do if you don't know where to start, if you don't know how to do the research, you could probably just pay somebody, just find some fee-based advisor in your country, whatever that is, in your jurisdiction, pay them for an hour of their time, and just ask. Their sole purpose for that meeting is to put together a list of ETFs that you can replace the American versions of. And I'm sure that an asset manager, worth anything, will know exactly what you're getting at and talking about. And you can pay him for that time. It would be worth an hour payment, whatever it is, $300, $500. Pay him, and then you'll always have that list. And then you can access the US markets directly, which, to be honest, just perform far better. It would be different if the European markets perform better. I wouldn't even tell you to do this. I'd just say, well, look, VTS is not for you. But unfortunately, you're in a situation where I'm not sure which country you're from, but if you're from the European Economic Area, it's almost a guarantee that your local markets get destroyed by the US markets performance-wise. So this is worth doing. I would just pay the money and get that list. If you have a Twitter following, you could also reach out and get a list there. Yeah. Have you ever missed a daily email? No, I haven't. Been late once. For example, if you've been a bad sick fever, stuck in the traffic. No, it's never... Knock wood, it has never happened. I launched officially in January 2012. That is over 13 years now of daily emails every single day, no matter what country I'm in, no matter what time of day. I've been in every time zone. I've been in every continent. I travel a lot, as you know, if you've watched my live streams. Backdrops change all the time. And I mean, priority number one in every country, I touch down, I make sure that I have internet in my Airbnb or my rental that I'm in, and B, I have pre-scouted out the 24-hour internet cafes, and everything is all mapped out. I've got my plan. There was one time where my internet in my hotel, it was the Hilton Hotel in Panama, it cut out, and I had to just grab my computer and run and go to the internet cafe, and luckily that worked. If it was I guess if it was a full grid lockdown, I might have missed it. But yeah, it's only happened once. But yeah, work is priority number one. And then I can be anywhere in the world. I can be taking my wife on vacations. Take my family, take my mom somewhere. Work is always number one. I was on a cruise ship in Norway last year for 3 weeks. I always found a way to get the email done, even though it was pretty sketchy around the Arctic Circle. There was one day where I was looking at the clock and looking at the internet and looking at the no connection and thinking, this might be the day, but I managed to do it. Yeah, I'll get it done. I'm not superstitious, but just in case the trading gods are watching. Are you still updating the spreadsheet? Yes. I'm giving you this answer because I'm not sure if you're one of them, but I've gotten multiple emails from people saying that the spreadsheet didn't update. And I am telling you, not you, I mean, this has nothing to do with you. I'm just answering your question. I updated the spreadsheet January 1st. So what is going on? Stock replacement, volatility data spreadsheet. If you go into here and you go into the first lesson, it's there. It's updated. You click it here and it's updated. And I've tested this link every time somebody emails me and says that it's not updated. And I know you're not doing this. I'm not hacking on you. You're probably just randomly asking me. But there has been some people there. And for some reason, even though it's been updated, I have had a couple people say it's not. So I'm wondering if there's a dead link somewhere. So if you are one of these people that tried to download the new version of the spreadsheet from 2024, updated at the end of December, and it doesn't seem right to you, let me know where you downloaded that from. It's possible there's a dead link floating around in a YouTube video I did or a link somewhere. I want to clean this up because yes, the spreadsheet will be updated quarterly. And it is updated as of December 31st, 2024. So, yes. How much does mentorship cost? It's free because I don't do it. I don't believe in mentorship. I think that it's the most egregiously overpriced way to learn how to be an investor. And I just wouldn't fleece people like that. I just don't believe in it. I could. I have hundreds of people ask me emails every single day. Hey, what's your, how much can I pay you? No, thank you. There's just so much more you can learn for such a cheaper price if you take me up on my VTS offer of a very low monthly subscription or a course, right? I don't personally have a course right now. I'm building one. But if you find somebody else that has a course, that would always be more worth buying. Maybe you pay $2,000, $3,000 for a course, but you have it, it's detailed, it's to the point and specific, and there's more than likely there's a method of still contacting and being in touch with the person that put the course together. So you're just going to get far more value for your money for doing that. I could charge you for mentorship and I could sell it like, hey, you're going to have a guy with 20 years of experience over your shoulder helping you how to invest. No. You're going to learn a fraction of what you need to, and you're going to look at your bank account and say, I mean, I've spent $4,000 or $5,000 on this mentorship, and I feel like, yeah, I learned something, but it's not worth that. That's what ends up happening. So don't ever, just general message to anybody out there, don't ever pay for mentorship. Don't ever pay for one-on-one coaching. It's a total scam. You're never going to learn even a fraction of what you could from taking a more long-term approach and paying for real value. So I would never fleece my community doing that. And you shouldn't do that either. So I don't have a course, unfortunately, so I would have to direct you to somebody else's course. But when I do have one, I'll make sure that it's good enough that I'm confident the money I'm charging is going to get you far more ahead than I ever could with whatever schedule of mentorship people charge out there. I see them on Twitter all the time. I just roll my eyes like, that can't be worth it. It's impossible that the value is there. It's just impossible. I send you email with info about school and nursery. Okay. I'm always interested in learning about Dubai. And yeah, actually, I remember you showed me that video of your kids in school. Dubai is, yeah, for the person who asked about raising families in Dubai, yeah, got a couple of friends like this guy. They will attest to how awesome it is. It's great. It's great. It depends what you're comparing it against. Like if you're comparing it against Taiwan, then I don't know. Maybe it's not that much better. If you're comparing it to, I also speak very highly of Japan. I've been there 7 or 8 times, and I think it's great. Economy-wise, maybe a little bit rough, but certainly livable, certainly zero crime, certainly great schools, respectful people. Yeah, travel the world. You'll start to look at your home country like, really, Canada? Is this the best we can do with all this money? Like 57% taxes, and this is the best you can do? Embarrassing. You got United States, all that tax money, wealthiest country in the world, most influential, billionaires everywhere you look. You honestly think Donald Trump, Elon Musk, Vivek Ramaswamy, David Sachs, all these billionaires that are in charge now that you've elected the oligarchy to your country, you really think you're getting universal health care out of this? Do people really think that they're going to bolster your Social Security? People really think they're there to improve the school system? They're going to reduce the crime rate? They're going to reduce inflation? Honestly, you think that? Okay. No, what's actually going to happen is they're going to reduce regulations so that they can absolutely fleece the U.S. Treasury. That's what's going to happen. But go to a different country that doesn't function that way, and you'll start to look at your own country and go, I should be demanding more from our leaders. It's embarrassing. And I love Vancouver. I hate speaking bad about it because it's a beautiful place, and I did live there for a long time. I lived there for many years, and it's awesome. I lived right on Stanley Park. Every day, go out running. It's amazing. But there's so many problems with Western countries that you just, paying that much money in taxes, you just can't accept those problems. It's just, you can't square that equation, unfortunately. What do you think of allocating just 2% in a short... This question always comes up. Allocating just 2% in a short buy and hold UVIX. If this trade goes bust because of some war, we have other problems. So just running the basic numbers. First of all, the reason you wouldn't do this is because you can make more money shorting volatility in a tactical way that is much safer with lower drawdowns. So you're actively choosing a worse strategy. So right away, buy and hold is off the table. You will always be able to find a way, if you understand how market dynamics work, stretched out over 10 or 15 years, you will always find a way to beat buy and hold. In a 3, 4, 5-year period, maybe not. If the market's doing extremely well in a certain short-term period, then maybe it does appear like, hey, just like you said, in the last several years, this does seem like a decent idea because it's performed reasonably well. And you look at it with recency bias and you think, yeah, well, I guess buy and hold has some merits. It doesn't. Trust me, it doesn't. There's going to be a time in your life where you look back on a 15-year period and you think, I can't believe people buy and hold the market. Like, didn't they know that every 10 or 15 years disaster happens? But that's the first problem, is that you're actively selecting a worse strategy. The second problem is you're not even safe with this. Just how much has UVIX spiked up? UVXY spiked up 1,500%, and that was at a 1.5 times leverage factor. I don't know offhand what UVIX did, but let's just say 2,200%. So you're talking about losing not just 2% of your money, all of your money. A short trade has unlimited loss, and UVIX spiked over 2,000%. Which means, just running the math, your 2% allocation lost you all your money. Not just 2%, 100%. Does that sound like something that you should do? Like, why? Why? You're on my live stream. I could understand maybe somebody doing this if they had no knowledge of a better way to approach the market. There's a lot of people who don't know that it's possible to harvest volatility metrics and exit before the damage is done. We will never be able to avoid a single day volatility spike. Nobody can see those coming. But what I can avoid is a 10-day drawdown. I can get out on day 2. I will never be able to avoid the first day or the second day, but I can definitely be smart and exit before a multiple day extended drawdown. So that's what I mean by tactical rotation. If you were the type of person that didn't know that this was possible, that you could just most of the time, 65% of the time, be short vol and then exit out into safety and protect your capital. Again, you're always going to get hit with those rotten days where, Wednesday everything's fine and Thursday the market's down 3% and volatility metrics get destroyed. That will always happen. But you don't have to do that for 2 weeks. You don't have to ride it for a month. You don't have to ride it for 6 months in the financial crisis. So if you didn't know that it's possible, then I guess I could forgive you. But you're aware that there are ways to take that 2% of capital and do something better with it. So I would just once and for all, I know like my live streams, this question comes up a lot. People will start with 20% and then I'll explain, oh, well, that wouldn't take very big a volatility spike at all. Oh, what about 10? Well, again, same thing. It's happened a couple of times in the last 10 years that 10% wipes out 100% of your capital. Okay, what about 5? What about 2? What about 1? What's the point? No number makes sense. 0.5% of your capital wouldn't destroy the rest of your 99.5%, but what is the point, right? Why? I'm not hacking on you. I actually sound like I'm being pretty negative to you directly. It's just a broad statement that there is no circumstance, there is no situation, no permutation of this number combination that would make buy and hold ever a viable strategy. Full stop. There is always better ways. My sister says, Prince of Wales, 10 miles. Well, I was 2.5 feet tall. It felt like it was, however long, uphill, 6 feet of snow. But thinking back, it was a walk. It took us well over an hour to get home. So, it must have been a decent distance. We used to take a break. There was a max, but basically people would know it as 7-Eleven. We used to have to stop there for a break. It was a journey, but we did it and it was safe. And there's no way that parents in that neighborhood these days would ever dream of letting their kids walk home from school now. The world has changed, but there are still places in the world that you can send your kids to school. And if necessary, like both my parents worked, we didn't have maids, we didn't have drivers, nothing. They just did the best they could. And we had to walk a lot. And I had to walk home from a lot of places. The old school Canada was amazing. This current version, not exactly a fan. I just want somewhere to put the excess I make from, BRR. I don't know what that stands for, but I know what you're talking about, where you, this is the real estate vernacular that I don't know, can't think of it right now. I know what that means, but basically you buy the house, you use the person to do the thing, you buy a triplex or something and you rent them all out. It's an investing style. It's good. The one problem with this, and I will draw a parallel to this, I'm sure you're way better at this than I am, and the risks involved, but just for anybody out there, real estate is not free money either, and real estate people are also suffering from recency bias because, of course, in the last several years, real estate values have gone up. So when people plug these numbers into their real estate models for their BRRR, I think there's 5 R's, isn't there? And whatever it is, they plug their numbers in. It just makes sense. Like, of course, this is what we should be doing. I promise you, there's going to be a decade where the numbers just implode and you're like underwater if you've leveraged yourself doing this, because it's just not going to work out the same way if you stretch it out over a 20, 30-year period and see what it actually means. There's a reason that rents and mortgages and interest rates and inflation, all these numbers work together over the long term. But there's certainly shorter 4 or 5 year periods where one of those numbers suddenly becomes very advantageous. In this case, the value of the actual home just skyrocketing and making your model look like, not to hack on you specifically, but makes these people think that they're genius investors when what's actually happening is just an outlier situation of an insanely inflationary real estate market that makes it seem like you're just making nothing but great decisions. Just, three-pointers all day long. You just can't believe how easy it is. I promise you there's going to be periods where just all your models implode and everything looks terrible. So be careful doing this. I'm so glad to hear you have excess money now, but I promise you there's going to be lean years as well. There's going to be lean decades doing this, just like with anything, just like with stocks, just like with bonds, gold, crypto. It's all the same. Be very careful measuring your success during a period of great success in the underlying asset. It would be a terrible mistake for crypto people to think they're good investors because they made money in crypto. I'm sorry to say, no, you're not. Maybe you are. But, you're going to have a 20-year track record to prove that. But there's a lot of people making money on crypto doing the dumbest things in the world. That does not mean that they're good investors. And stock market's the same. There's a lot of people in the last 5 years that really think that they're doing great because the more risk you took, the least amount of risk management you employed, probably the better you did. That doesn't sound like a very good benchmark for success to me. I'm old now, I'm 50 now, but I've still got 20 years and investing is a 40-year time horizon. You can't let 3-4 years of an outlier allow you to drop the ball on what the world actually functions and how these things actually work. These relationships under normal conditions, long-term, how they interact with each other. The world in the last 4 years is broken, just broken. So I'm so glad when I hear people, they built up money. They made money the last 4 years. They had a house that skyrocketed. They had crypto that, they just bought the right combination of silly meme coins and they did great. Good. I will always cheer for people making money. The world will not look like this for very much longer. I'm not a doom and gloom person. I'm generally bullish. Things do go up over time with very uncomfortable periods in between. And that's what I focus on. I don't want to drop the ball here. It's a rough period. I don't know what to say. I think I've said enough. Do you plan to teach zero DTE? Yeah, I do. Absolutely. Part of the VTS Options Academy. Of course, with zero DTE, like with iron condors, I've been trading them since 2006. I've been trading short vol since 2007 with options. And immediately in 2010, when the products were around, I was trading XIV, VXX in 2010. I've actually shown my first VXX trade. It was like a $60,000 trade in mid-2010. I was trading these products. With zero DTE, my experiences with just having 20 years of investing is helpful. But with zero DTE, I've been going for 2 years. So it's a lot of it is going to be education. And a lot of it is just going to be us growing as a community together, sharing ideas with each other and tossing ideas back and forth. And I'll do the legwork in most cases to crunch the numbers and throw on my risk management hat, which I'm very good at, and critiquing other people's strategies and saying, hey, I can see some holes here. But in general, it's going to be this specific part of my options will actually be a little bit more open and interactive. And not to say that I'm ever like on the pedestal or anything. It's just that it would be difficult for anybody to offer anything as far as iron condors or butterflies or volatility trading that I haven't thought of, tried, tested, and gone through the motions completely with. It would be very difficult for you to find that in those areas. But with zero DTE, I'm also interested to hear what other people are doing because it is a new thing. So I'm looking forward to this actually more than most of the other things. VIX options I've been doing month after month for 14 years now. It's just I don't even get any feeling from it anymore. But zero DTE is still fun for me. So yeah, I'm gonna enjoy that. Can you backtest your SPY and QLD signals to see how futures ES and NQ would perform for the last 5. Well, what do you mean by futures? Like just saying futures, I don't know what specifically you're talking about. Basically, how many points would you have made with each signal to buy, sell, SPY? What time frame? I would have to know. I understand what your question is. I'm not trying to be difficult here, but I don't have enough. That's a super broad term. Like, how would it have done with futures? I don't know. Do you mean every day that I take a signal, I take a 1-day futures trade, I take a 2-week futures trade, I open a stock replacement with options type thing? I need more information. Good question. I like where you're going with this. I just don't. Yeah, like I said, I need more specifics. I'll try to take a stab at it though. So the thing that is going to end up happening here, it doesn't matter what time frame, right? You have to tell me what it is, but whatever it is going to change the risk reward ratio. The only thing that doesn't really change the risk reward ratio is stock replacement with options, whether long puts and calls, risk reversals, things like that. It generally will behave the same as the underlying because we're opening and closing them at the same time. But oftentimes people ask these types of questions. They'll say, well, okay, instead of buying SVXY, what would have happened if you bought vertical options? What would have happened if you opened an iron condor on the same day? These are totally different risk reward profiles. So it's no longer a trend following strategy at that point. It is a static option strategy initiated with those signals, which would be a good way to do it. With options trading, of course, you need entries and exits. So my entries and exits, if you were to try to employ, every time my dials move into a certain range, you initiate a short vol trade, something like that. But the longer it goes, like over 1 day, it's the same. Over 2 days, it deviates. Over a week, it's not even the same strategy. So I think that's the problem that you will run into here is if you're talking about anything other than just general stock replacement, it changes everything. And there would be nothing wrong with that. I have tons of option strategies that I do, but they're not trend following. Trend following is always best done with ETFs because you can just buy it and just hold it until you no longer need to hold it anymore and just switch it out. It's never the only reason you would ever substitute is if you lived in a country that restricted your ETF buying. Otherwise, if you have access to it, it's the best trend following method is just buy these nicely prepackaged ETFs that they offer us. When will vol return? Well, it returned for 1 day this week. Anybody remember that? There was a massive volatility spike just a few days ago. That's what I mean about this market. It is unbelievable how many times that has happened. It's just, that didn't used, I assure you as someone who's been doing this a very, very long time, that didn't used to happen. This market is not normal. And I can't say when it's going to revert back to the mean, but I'm telling you, we have had more 1 and 2 day scares that turned out to be absolutely nothing than I have ever experienced. There's been more of those in the last 4 years than in the last 20 combined. It's just one of those markets that nothing can bring this thing down. But when it fails, I'm very worried that people who have been doing very well will be very quickly reminded and be taken very close to where they started. And I know that sounds like hyperbole, but let me see if I can illustrate this. Right here, in 2014, the Dow Jones, the S&P, and not the NASDAQ, but the Dow and the S&P, and then at the COVID bottom, touched the same spot it was at 2014. And they spent about, I don't know, $6-7 trillion to make sure that that bottomed right there. But it could have easily gone down another 10 or 20%. And it could have lasted a year or two or 17 years, as we've seen in the past. That's going to happen. And it's going to happen in all of these assets. It's going to happen in the housing market. It's going to happen in crypto. It's going to happen. People have to understand that it's great that you've made money in this, rabid market that we've seen, but you got to hold on to that money. You really do. Otherwise, it will go back to the same spot. It will. And when it happens, people will look back and just think, God, I should have just expanded my chart a little bit. I would have known this was happening. But so many people are like this. They're seeing the last 4 years. Just expand it a little bit. I promise you, if you just take a 20-year view of the market or a 30-year view of the market, you'll be able to hang on to your gains. You'll find a way. You don't need me. I mean, I'll help you if you need me, and I've got a business based on helping people, but just expand your view and you'll realize, what's going on. But yeah, to answer your question, I don't know. I mean, do you mean a long sustained? The next volatility spike is probably going to happen in 3 days. That's the type of market we have. But a sustained one, I don't know. I know I'll be ready when it happens, but I don't know when that's going to be. At some point in the future, people are going to look back on these live streams and think, he was kind of saying that the whole time. But I understand right now, this is just, what do they call it? Old man yelling at clouds. It kind of sounds like that because risk management has not been necessary the last few years. I promise you it will be soon. Extortionism doesn't work. Taxation doesn't work. If you point to other countries saying, see, it's working, it's only for a while. Corruption is a poison and it comes from taxation. I think you have, I see what you're saying, and I think you have a point. And one of the things that I worry about is, well, not worry, because you have to have an open mind and you have to be nimble and be able to move around the world. But, I would say that there's some people right now in Texas who are experiencing this idea that 5-6 years ago, smart people were leaving California and going to Texas. But, well, what happened? Well, the Californians went to Texas. They brought California with them. So in a lot of cases, what you're saying is kind of true. The problems follow where the people are going. So I'm not going to say I'm worried about Dubai, but I've already started to notice a few things that are like, I can sense that problems are starting to arise. Not yet, but, traffic being, they should take care of that a little bit. The massive immigration, the expansionism, I mean, maybe slow it down a little bit. Just make sure that you're solidifying these areas before expanding even more and more and more and bigger and better and faster and stronger. That's what Dubai is all about. So I see what you're saying. And point taken, Dubai now does have a 9% corporate tax rate. So there's that. Income tax is still 0, but corporate tax is now up to 9%. There's massive levels that you have to cross. A business of my size is not going to trigger a 9% tax rate, but yeah, I see what you're saying. Now, I disagree in the sense that taxation, I don't know, you didn't specifically say it, but I have noticed lately that there is this movement of people thinking that zero tax globally would somehow work. Like they say, what are the, taxation is theft and it should be 0. And why do we pay taxes? If you can print your own money, why do we even pay taxes at all? I'm not there. I can't agree with all of that. There is a cost associated, and a community has to come together to pay for those costs, because if you leave it to the individual, it's not going to be very long before it turns into, that movie Elysium, where all the rich people live on the space station on the moon and 99% of the rest of the peons live down on Earth and just fend for themselves. That's what's going to happen. So, of course, you have to come together as a community and agree that we're all going to pitch in some money and we're all going to make everybody better, and we call that taxes. Unfortunately, the people that we put in charge of that treasury to hold the taxes and to distribute them effectively, they're the people that are actually stealing most of the money. And again, get back to my previous rant. For all these Americans who think that they have suddenly now voted in the responsible adult billionaires of the world to take care of the problem, boy, you think Elon Musk cares about your universal health care? I mean, you think the agency of Doge is interested in that? I mean, you're talking about a guy who received tens of billions of dollars of government subsidies, right? Socialize his companies, but capitalism for everybody else and fend for yourself, right? Trim, everything. got to cut the government, got to do all these things, no more handouts. You mean other than the handouts, the tens of billions that you got, right? You mean other than those. I just find it to be, again, this is going to be one of those things where 5 years from now, people are going to see it as clear as day. But right now, there's still that feeling that somehow the world has changed and the billionaires are in charge now and they're going to fix everything. They'll fix everything all right, but those people I mentioned, the David Saxes of the world, they have one skill that the rest of us, the most of the rest of us don't have. They have spent their entire lives honing the skill of taking money from your pocket and putting it in theirs. And now we've elected them as positions of power. We're going to lose that game. I promise you, these people are going to find a way to rig it for themselves. So again, if you're not in the top 10% of Americans, that country's not for you anymore, unfortunately. It probably never was. Income inequality in the Western countries is off the charts, but yeah, they're going to beat us. I promise you that. These billionaires are going to beat us. So I don't know where that came from. Side rants all over the place today. In 2021, I think you stopped to trade the tactical vol. Can you elaborate on why you did? This is a good question. What did you see back then and why is it different from now? It's actually not that much different now. So the reason that I stopped trading it was I analyzed the markets constantly every year, of course. And in 2021, turning over the calendar to 2022, I was doing my annual analysis and the market was doing, actually, like I said, this is a great question because it was kind of doing what it's doing right now, which is large volatility spikes that turn out to be nothing. And the thing about volatility products specifically are they're fantastic products because they follow long-term trends where they massively outperform. And then they have very sharp spikes, declines, in the case of SVXY or XIV, where if you can just trim those off, you can make an amazing rate of return. But what ends up happening if you get massive volatility spikes, you get hit with that spike because nobody can see that coming. You can't, I don't know, like right now the market's stable, right? Let me just check in case I put my foot in my mouth. Yeah, it's up, it's decent. For all, like right now, there's no reason in the world not to be allocated to the stock market, to short volatility. We're aggressive across the board. There's no reason not to be. But I don't know if I'm going to wake up Monday and have this thing just fall off a cliff. So you'll never be able to avoid that. But ideally, what you would want is volatility spikes lead to at least a week or two of uncertainty. And then you can trim that and you can do better long-term with volatility products. But in 2021, and I would make a case, we're getting close to that now, but I'm not gonna stop trading the tactical vol again. But equities just perform better in that type of environment because the volatility spike / stock market crash that single day, it hurts stocks as well, but it hurts stocks less. And the trends that do extremely well, stocks don't do as well as short vol during really long, stable trends. But in an environment where you're getting a lot of sharp volatility spikes that don't lead to anything, actually equities outperform. And 2 times equities even outperform. So in this type of environment, and you can see it in the results of my strategies, if you compare defensive rotation and tactical volatility to each other, long term, they both make over 30%. But in the last 5 years, defensive rotation has handily beat tactical volatility. Short volatility in the last 5 years has been subject to this problem that the long-term trends aren't good enough and the short-term spikes are too big. So short vol has wildly underperformed leveraged equities in the last 5 years. Now, the reason that I will say that I'm not going to ditch it and just go back to like I did in 2021, I stopped trading this strategy for a year. Substituted in an equity strategy. I won't do that again because, of course, I don't have a crystal ball. I don't know if this is going to end tomorrow. I don't know if tactical vol is going to suddenly start outperforming defensive rotation again. They're both very good. And I know from a 13-year track record, they're both phenomenal strategies. It's just this one hasn't done that well in the last few years because of the market that we are in. That's why I stopped doing it back then. And like I said, you could make a case that we're in that environment again. You could make a case that short volatility today isn't as good as leveraged equities. But diversification means trade all the good ones in the same portfolio, and this is all going to work itself out in the long run. Like, I mean, doing this is going to be better long term. It has turned out that it's not been better in the last several years, but like I said, investing is a 30-plus year endeavor. It is not a 2-year, let's use a crystal ball, let's figure out the perfect combination of everything. It's never clean like that. Okay. Here's a question regarding futures. He's asking to replace ETF to front futures of ES. Much easier to leverage with futures. I guess you'd have more work. You'd have to continue layering. You'd have to add layers of risk management if you're doing that. But I guess if you're trying to simulate the overall direction and you're talking about just doing leverage, I mean, come on, my friend. How many times have we had this conversation? I get it. You love taking risk, but I don't. So much easier to leverage. It's funny how two people can see the world, the investing world, so differently. Like when you say it's easy to leverage, I would say it's easy to end up over leveraged, right? I would always see the opposite side of that coin. So I think we'll agree to disagree. I don't think I have difficulty finding areas to leverage. Like obviously if a person wanted to, and I even specifically said it in one of the strategies, QLD isn't the most leverage. There is a TQQQ. There's a triple leverage. Don't do it. Please don't do it. But like I said, if you have a lower risk tolerance, you can substitute for the Qs. But strategic tail risk, we only use SPY. Look, I'm not going to tell you what your risk tolerance should be. If you want to use the 2x SPY, the SSO, be my guest. But again, this is not a problem of me not having access to more leverage. This is me actively trying not to leverage, right? I don't need the leverage. I've said this a million times before, but if a 20% annual rate of return is not good enough for you, you have a spending or an income problem. You don't have an investing problem. You have a lifestyle budget management problem. That's what it is, because a 20-year rate of even a 15% annual return for a 25-year period is phenomenal results. And if you could get that and you had a responsible savings plan, like stuff away $1,000, $2,000 a month, have a decent income, boy, you're going to be a mega millionaire. Do you know how much that compounds into? But when people start saying, they'll see the defensive rotation, it's made over 30% a year, live trading, I think you need more leverage. I don't think so. I think we need responsible budgeting if that's not good enough. So I'm personally not going to chase better than I do. I'm just not. I cannot be convinced that I need more than what I'm doing. I just don't. If you are convinced that you need more, I can't say you're wrong. I can say it's probably not investing related. It's probably you've got your eye on a Bugatti that you currently can't afford, and you think, well, I need 50%, I need 80%. I don't want to be a millionaire in 10 years. I want to be a millionaire next week. That's a you problem. I'm perfectly comfortable growing slow and steady, 15%, 20%, amazing. No complaints. But I know you. We've had many a conversation about over leveraging. You do you. And maybe it'll work. Maybe it'll work. We will revisit this conversation at the heart of a crash, at the heart of an extended recession. We will revisit this conversation. Until then, good luck, stay safe. We will agree to disagree. Let's keep it simple. When SPY signal says buy, you buy ES futures. When it exits, go to IYR. You sell your ES contract. Yeah, okay. It's fine. I see nothing wrong with that. Again, allocation sizing, it's never a one-to-one. It's not quite that simple. And just full disclosure, I don't trade futures within our community at all, ever. And it's not because futures aren't just as good as options. They're basically the same, just you have to know a few different things. Basically just as good as ETF trading. As was said previously, it's easy, it can be tax efficient. It's a whole layer of explanations and additional emails and troubleshooting questions. So I'd like to keep things extremely simple. And since trend following is so effectively done with ETFs, and I would argue most effectively done with ETFs, then what's the point? But sure, if you are a sophisticated enough investor to just do your own replacements, and all you need me for is my work on analyzing the volatility metrics to get the actual entries and exits, and then once you get that signal, you do with it what you want, go for it. If you know what you're doing, then do it. It's like I said, it is about entries and exits, more so exits than entries. But yeah, take my work and use it any way you see fit. I present it in a way that's easiest and most efficient, minus the additional extra tax efficiency of futures, which I think you're going to get me on a follow-up here, but granted. But yeah, it's mostly just ETFs are just so easy and efficient to use. How often do you inject capital, I assume? How much % of your income? Dollar cost average, or do you just do it constantly? So good question. I got this one very recently as well, I think in an email somewhere. Could have been you. I don't have a schedule. I know that some people, like I don't know if Dave Ramsey does this. I was just using his name as a person who probably has something like this, where you're supposed to invest a certain percentage of your income. I just live my life. I just know what I make. I know what my potential future earnings are. And I just, I could be called a little bit spendy. Hope my wife's sleeping or has her, her headphones in when I say this, but she's spendy. So, I do what I can. I don't do it on a schedule. There's been times when I'll go on a big vacation. We spent, I spent $70,000 to take them to Norway and France last year. So obviously I didn't save during that month, but I just do what I can. As far as, so percentage, no, I don't do that. I just more or less every year I save a good chunk, but month to month, it's not consistent at all whatsoever. As far as dollar cost averaging, for this, the way that I invest, dollar cost averaging happens automatically. I call it what is, constant portfolio rebalancing. So if you were to imagine right now, this is my portfolio. These are our positions right now today, and 25% across the board. But these were entered on the 30th. This was entered on the 15th. So we've been leveraged NASDAQ for, 2 weeks now, 30th, 22nd. Basically, these are the positions until they're ended. So let's say I had $10,000 today that I wanted to inject into my trading account. I would put the $10,000 in, but I wouldn't allocate the $10,000 to any of these positions. The $10,000 just gets added. The next time I switch positions, if the SVXY goes into the GLD range, at that day, I would buy 25% of my capital into the GLD, which means that $10,000 gets invested with every new signal. So it is essentially dollar cost averaging my portfolio every single time I make a new trade. All capital for every new trade gets allocated at the desired amount. So if I injected capital today, there might be a short-term period where that money is just sitting there. You could allocate it if you wanted, but it's kind of a non-issue. But as you can see, like over time, my money is always efficiently used in the percentages. So as far as VTS goes, 4 strategies at 25%. It's actually trimmed down to about 60% because 40% in options. But you get the point. Every new trade is perfectly allocated in the right allocation. So I don't have to do any of that. I don't have to calculate anything. The next time I switch position, the new trade gets 25%. The next time I move into XLU utilities, it gets 25%. That's how it works. What was your last part? Or do you do it constantly? Constant portfolio rebalancing. But look, as far as advice for other people, I'm not saying this to say, sounds awful when you say it, but I mean, my income is high-ish. So for me, I suppose it is a little bit less important, but look, money is hard to make in this world, and I definitely do support the general principle of trying to save a consistent amount every month. So don't think that just because I don't personally do something that I can't also say, well, it is actually a good idea. Yeah, as far as a percentage, hopefully that's changing, because income is by far the most important thing. That's the most important part of the equation, is growing your income. So as your income grows, don't continue to, you know, I don't know, should I play a 45-second clip to explain what I mean? People might find it entertaining. I don't know, but yeah, here we go. Do you know why you still feel broke? It's because no matter what you buy, there is always a more expensive upgrade. Oh, you bought a nice bottle of wine or whiskey to celebrate an achievement? Great, but there's millions of bottles more expensive than that. You landed that promotion and bought a Rolex? Awesome, but a Rolex doesn't even scratch the surface of how expensive watches can get. You bought your dream car, a Corvette C8? Great choice, I love those as well. But that's average price at best at any local cars and coffee meetup. Restaurants, gifts, hobbies, travel. The point is, there is always another level above where you're at. If you don't train your mind to be happy with what you have now, lifestyle inflation will eat your retirement account alive. For most people, the more they make, the more they spend. If they barely made ends meet when they were making $75,000 a year, they'll barely make ends meet when they get to $150,000 a year. And bumping it to $200K a year won't mean anything, because there's always a Patek Philippe or a Lamborghini with your name on it. You have to stop upgrading your lifestyle every time you increase your income. All right. Short little lesson, but sweet and to the point. Yeah, I would do a percentage of your income. Nothing wrong with that, but just make sure that that number is growing every year. Or, you know, reasonably every couple of years, every few years. And have some fun as well. I mean, we got to live our life. There's plenty of time to bear down and make money. You know, this is one of the things, like, people try to save money in their 20s and 30s. Spend a little, save a lot. Live your life. Trust me, when you're 50 or 60, you probably won't mind working. But when you're 30, if you don't take that epic vacation, or if you're in your 30s and you like cars and you don't ever buy yourself a cool car, that's kind of a shame. Go ahead and get it. Don't break the bank. Don't go into debt. Don't use your credit card, but have some fun. You have huge potential with your signals to be used for futures, either ES or NQ. Not to sound pedantic, maybe I could mentor you on how to apply your signals to ES future trading. We could have a web video call and I can explain if you're interested. Well, I understand futures and I do trade futures, but so I wouldn't need like explanations or mentorship, but yeah, I would absolutely be willing to go on a call and listen to what you're saying. I don't doubt that there are ways to simulate what I do. I just don't think that it would improve the results, because everything is a risk-reward equation. So I have no doubt that you have ways that you could substitute futures and make it, as our previous friend said, easier to leverage. Sure, but why would I want that? So if that's what you're trying to do, if you're trying to teach me how to over-leverage my signals, I don't disagree with you that there are many ways that I could take on more risk. There's infinite ways that I could use more efficient options or future strategies and get multiple leverage factors on an ETF. No problem. I mean, I know how to do that. I don't want to do that. That's the point. But sure, absolutely. I'm always looking to talk to people who are investors and learn a few things from each other. That would be great. I don't have the Excel skills to do the back testing. Neither do I. As I've always said, I'm not a programmer. I use Excel almost exclusively, but I use it in the sense that I barely know enough, and I learn if I don't know enough to just get the job done. So I'm not some Excel wizard either. Are you still using Interactive Brokers for trading? I live in Canada. What do you recommend? I still actually am, but every couple of weeks I remind myself, I'm supposed to switch out. I'm just done with it. And it's just because it's the trading platform visually. I have no problem with Interactive Brokers. I just can't stand logging into that platform. And now that TOS looks great, the fees are more competitive now. They're still not as good as Interactive Brokers, but I'll pay the fee spread to not have to see that disgusting software ever again. But yeah, my long-term portfolio is still at IB. SIBO is adding a new product for VIX options futures. The argument he's making is valid. Whose argument? Did I miss a question? Probably missed something. The argument he's making is valid. What argument? Are you trying to refer to the... No, that wouldn't be about the future stuff. I don't know. Sorry, Matt. I don't know what this is referring to. As I have to sometimes remind people, my eCam software doesn't always show me every comment. So sometimes people say something and it sounds to me like it's out of nowhere. I don't know what this is referring to. SIBO does add new products and people tend to think they're a big deal until we realize that they're really not. You don't actually need more of those somewhat useless things. Like the VIX one day came out and everybody was freaking out for a week. Like, oh my God, this is amazing. It's nothing. It's just a statistic on one day VIX. It doesn't mean anything. The VIX 90 is already fairly useless. The VIX 1D, I mean, I don't even look at it. There's a lot of VIX futures volatility products that are just totally unnecessary. So I don't know which one you're referring to, but 70,000 vacation is nice. Yeah, it was fun. We went for 5 weeks. We did 6 countries, 3 weeks on a cruise ship, 2 and a bit weeks just hotels in, we went to Amsterdam. Took the wife to France for 4 days, which was crazy expensive. So you can imagine a woman in Paris. We went to Belgium for a while. We went to, it was awesome. That's a down payment on a nice home in a nice school district here in Detroit. Well, it doesn't buy a whole lot in Vancouver, I'll tell you that. But that sounds nice. Maybe I should consider Detroit. I live and work in South America. Take a wild guess my income. Aside of booze and cigs, I am frugal. Still a ballpark. N0 will improve my CAGR, I suppose. I don't want to guess your income. Do the best you can. Save. Like I said, save more than you make, obviously. Spend a little bit. Definitely give up the booze and the cigs. You don't need that in your life. What are you doing there? This is just old man giving life advice. But yeah, not because of the money spent, although that's part of it. But yeah, you don't need that. Save that money and take up running as your free hobby and buy yourself a sports car. Absolutely not. My request has nothing to do with leveraging. Great. Then I'm in. I would like to hear what you have to say. And like you said, you're not able to backtest it. I don't know if I am either, but I'm certainly willing to hear you out. And if I get an idea for, hey, I could probably run a few numbers on this, maybe I'll be pleasantly surprised. Maybe you'll be surprised, but maybe both of us will learn something. So yeah, I'm not here to say I have all the answers and my way is the only way. There's hundreds of ways to invest successfully. Unfortunately, most people in the world don't know any. I know several, but most people, unfortunately, they don't know any. It sounds like you know several as well. So we should definitely have a chat. So emails are always open, and that's it. Thank you, everybody, for the support. Not only today, that was awesome. Back in the groove. It's been a couple of months. This was a little bit awkward. Rough start there. But also, thank you for the long-term support. That's 30,000. I wonder what we can get to. I wonder if by the end of the year, is 35K ambitious? Is 40K even possible? I don't know, but subscribe if you haven't. It's funny, only about 30% of people that watch my content have actually subscribed. So I don't know why that is. Maybe I should do better content. I don't know. Yeah, thank you, everybody. We're going to call it there. And next week, there will definitely be a live. I'm going to start doing more of these. The only reason that I took time off, it's not because I haven't been doing anything. I actually made about 40 videos in the last 2 months. I've made more content in the last 2 months than I've ever made. It's just that it's all private because it's part of the options community. So it may appear like I've just stopped working and I'm lazy, but I assure you I've done more in the last couple of months than I ever have. So it's coming. Bear with me. Not quite ready to say it's soon. I wouldn't say the word soon, but it's ish. All right. So see you next week, everybody.